This is part 2 of financial statement analysis. Okay, so last video talked about vertical analysis and horizontal analysis. Now we focus on ratio analysis. Now ratios measure short-term liquidity, long-term credit risk, and profitability. It can also measure or evaluate the current market price of a common stock. Now, for short-term liquidity, this actually means that given your current assets, can you actually cover for your current liabilities? Why is this important? Well, if you can cover for your short-term liabilities, what more for long-term debts, let's say. So that also measures your long-term credit risk. So for example, if you borrowed money from the public, can you actually pay? Profitability would mean, are you earning profit? If yes, by how much? Okay, so standards for comparison. Now, financial ratios shouldn't be considered in isolation. It has to be compared with something else. So that could be either inside the company, let's say one subsidiary versus another, or it could be comparing your company's performance in the previous year compared to, let's say, this year. Your financials could be compared against a competitor. You can see if you're more liquid, if you're more profitable. A company can also compare itself to the industry. For example, if you check your monitor and it says that the growth of real estate companies or the real estate industry is by this much, and let's say you want to check vis-a-vis your own real estate business, then you can do that. Or sometimes you can compare your financials to guidelines. Let's say there will be the demand for rice would be a certain amount, and you can double check with your numbers. Am I performing at par, or am I doing worse? There are 4 types of financial ratios. You have the following: liquidity ratios, activity ratios, debt and solvency ratios, profitability ratios. So for liquidity ratios, this pertains to your ability to pay short-term liabilities as they fall due. You have net working capital, which is equal to current assets minus current liabilities. At this point, I suggest that you review your classifications of accounts from Accounting 10, because if you still don't know which accounts would fall under current assets and which ones would fall under current liabilities, fixed assets, your long-term liabilities, then you are going to have a hard time in this topic. So kindly review, please. Now, for net working capital, what you can see here is that when we get the difference of your current assets and your current liabilities, if you get a positive number, then it means you have more current assets than your current liabilities. If you end with a negative net working capital, then it means you have more current liabilities than your current assets. Now, for current ratio, the formula is current assets divided by current liabilities. This shows you the number of times the current assets could pay for the current liabilities. So actually what you do here, the label for this would be, say, after you divide the number, it's times. So for example, you get 5. So that means your current assets can cover for your current liabilities 5 times. In this ratio, the higher number you get, the better. Now, you may be thinking, what if you get 1? Then it means that your current assets are equal to your current liabilities, which means your current assets can only cover for your current liabilities once. After you've paid for your current liabilities, then you won't have current assets to serve as a resource for your company. Now, a stricter version of the current ratio would be the acid test ratio, also known as the quick ratio. It has a similar formula, except in the numerator part, the current assets. Current assets will not include the inventories and prepayments. So what would that mean? Prepayments would be, let's say, prepaid rent or prepaid insurance, anything that's prepaid, that would be considered a prepayment. This is a stricter form because it takes away the less liquid current assets, meaning inventories and prepayments, they're harder to convert to cash, therefore they are less liquid. And by doing so, we can see that given that we have very liquid current assets in the form of cash and let's say accounts receivable, we will be able to determine by how much of these current assets can cover for the current liabilities. Like the current ratio, the label for the answer in the acid test ratio would be times, and the higher number that you get, the better. Next set would pertain to activity ratios. Activity ratios pertain to the speed with which various accounts are converted into either sales or cash. First up, we have the accounts receivable turnover, wherein it's computed by dividing the net credit sales divided by average accounts receivable. Net credit sales means sales on account. So for example, if I'm selling pens and after selling a pen, my customer tells me, I'll pay you next week. Then I would record that as a credit sale. And then average accounts receivable would be the beginning accounts receivable plus the ending accounts receivable divided by 2. Now the label for accounts receivable is times. So for this ratio, the higher the number you get, the better. It means that you are converting your credit sales at a faster rate. And then for average collection period, this pertains to the number of days that you can collect or that you can convert your accounts receivable to cash. So you can use this first formula here, average accounts receivable, which is just beginning accounts receivable plus ending accounts receivable divided by 2, then divided by your daily credit sales. And another formula would be number of working days in a year divided by your accounts receivable turnover. The label for average collection period, again, would be days. So just like any other business, you would rather collect faster or in a less number of days compared. So for example, if you can collect in 5 days versus 15 days, it would be better if you could collect in 5 days. Another activity ratio would be the inventory turnover. This measures the rate or how fast your inventory is replaced during the period. So that's computed by cost of goods sold divided by average inventory. Average inventory can be computed by beginning inventory plus ending inventory divided by 2. The label for this inventory turnover would be times. The higher the better because it would mean you're replacing it faster. Now for accounts payable turnover, the label is also times, and this measures how fast the company can pay off its suppliers, and that could be computed by dividing the net credit purchases, or in other words, purchases on account, divided by average accounts payable. Average accounts payable can be computed by adding the beginning value plus the ending value divided by 2. Average payment period pertains to the number of days during which the company pays its short-term payables. So ideally, you pay off your payables within or before the due date. You can compute for this by dividing average accounts payable, so that's just beginning plus ending divided by 2, divided by daily credit purchases. Or another way to compute for this would be number of working days in a year divided by accounts payable turnover. Now, for fixed assets turnover, this measures how efficient a company is using its fixed assets to generate sales. So remember that assets are resources that a company uses to earn or to get revenues. So in this case, to compute for that, we divide sales by the net fixed assets. This is net because this already includes the computation of accumulated depreciation. So that means, let's say if you have a building minus the accumulated depreciation, that's your net value. That's the net fixed asset value. The label for this ratio would be times, and the higher the better, meaning if you have a higher fixed asset turnover, it means you're more efficient in using that fixed asset to generate sales. Total asset turnover, on the other hand, looks at total assets in a way that it checks how efficient the company uses the assets or all of its assets to generate sales. The label for this would be times as well, and the higher the better. So formula is total asset turnover is equal to sales divided by average total assets. So that's just beginning plus ending divided by 2. But let's say in one of the problems, let's say you're not given any beginning. So you'll just have to make use of what you have, just use ending total assets. Next would be the debt solvency ratios. This would be the third set of your financial ratios. Now, when you say solvency, it means a company's capability to pay all of its liabilities, whether they are current or non-current. So first up would be the debt ratio. The formula is total liabilities divided by total assets. Actually, you have to multiply this by 100 so that you can end with a percentage. But what this is saying is how much of your total assets are funded by debt. So let's say you got 80 here, then it means that 80% of your total assets would be funded by your liabilities. Next solvency ratio would be the equity ratio. This shows how much of total assets are funded by equity. So actually what I like about the equity and the debt ratio is if you know already one ratio, let's say debt ratio, let's say this is 80%, you already know the equity ratio because, for example, if 80% of your total assets is funded by liabilities, then the rest would be funded by equity. So meaning that remaining 20% would actually be the equity ratio. You don't have to compute for it anymore. But if you are doubtful, then this is the formula: total owner's equity or total stockholders' equity divided by total assets, multiply it by 100 so that you can express it as a percentage. Now, third one would be the debt-equity ratio. We are comparing the total liabilities, current and non-current, divided by the equity. Now, for this one, this is not expressed as a percentage. It's expressed as in decimal form. If you get a value higher than 1, then it means that you have more liabilities than equity. Or in other words, your assets are funded more by liabilities or by debt than equity. If you have a value of 1 in your debt to equity ratio, then it means that your assets are equally funded by your debt and your equity. Now, if you get a value less than 1, it means that the company is funded more by equity. Next is the times interest earned. Remember, if you are borrowing money, then you have interest along with it. This pertains to the interest expense, this denominator here. What you want to check in this ratio is if you can actually cover for your interest expense given your earnings before interest and taxes. So what you do here is just divide EBIT divided by interest expense. And the label here is times. the higher the better.